So this evening, guys, we are going to focus on risk management. This evening's training is on risk management, and this is just basically based off some of your suggestions. You know, I usually do my intraday trading training every Tuesday at this time. But I mean, I think if you've come on a couple of my calls, you probably know I've recorded all the sessions. So in case you missed any of the past sessions, they're all recorded. They're on my YouTube channel. So today I just want to focus on risk management and helping you guys and everybody, including myself, remind ourselves about, you know, just how to manage our trades, manage our trading, become a bit more professional at what we do. So this won't take a long time. I'll just quickly take you through this slide. So we'll cover, I'm just trying to look at my notes. We'll cover trading the plan, tools to keep in handy, position sizing. Yeah. So let's begin. Okay, so guys, when it comes to trading, you all know that for you to become a professional trader or to really become focused on your trading, you need a plan, right? So the title of this presentation is just plan the trade or trade the plan. And usually the question we ask is, what is the most important thing a trader can do to increase their profits? This is especially for the new people on the call who have probably not been through this training with me. And people who have just gotten started with trading and they're trying to figure out, okay, how do we do everything? You know, it's so exciting. You're learning how to trade, you're starting to make some money, but how do you plan so that you're always in a position of profit, or you're always at least winning most of the time? So that's why the first thing we encourage people to do is to trade the plan. Yeah. And I'm going to ask you guys, please keep your mics muted. I really appreciate it. Please keep your mics muted. Do not unmute your mic. If you unmute your mic, I will just remove you from the meeting. Thank you. Yes, so, and the only reason is, guys, I usually get very distracted. So when I hear any sound, my train of thought disappears, and by the time I come back, it's like it's gone. Yes, so we'll continue. Yeah, so basically, for the new people on the call, I mean, to the IM Academy, we're just talking about planning our trades. And why do we plan our trades? Yeah, and maybe you can just take a couple of notes. I'll just quickly go through these slides. Some of these things are very straightforward, but it's just good to have a reminder about why it's important to have a trading plan, because that's what we're talking about today. So the first reason is, you know, just to give ourselves boundaries on our trades, you know, like we know, for example, when to get in and out of trades and so on and so forth. Yeah. And if you think about it, when you have a plan, you have a standard to hold your actions against, meaning that, for example, if you don't stick to your plan, okay, then we can then come back to you and say you didn't stick to your plan. So if you lose money in the market, the first thing usually when people come to me and tell me they're losing trades or whatnot, I'll always ask them, okay, fine. What is your plan? Like, for example, when you went into the trade, before you went into the trade, did you decide at what point you're going to leave the trade? And that's where things like stop loss and take profits come in. And then before a plan, you know what to do, okay? You know what to do before you get into a trade. You know what to do if a trade goes badly. You know whether do you stick around, are you going to pull the plug, and so on. And we keep on saying that failure to plan, and I'm sure you've had this from very many educators in the academy, very many professional traders as well, that the failure to plan is you planning to fail. So if you're trading as of today, but you don't have a trading plan, then basically, yeah, you're literally planning to fail. Yeah. Okay. Now that said, there's usually a typical way in which you can plan. You can create a trading plan. Okay. And this is just the basic structure for your trading plan. Okay. So the first section is the methodology. Okay, so when you're coming up with a trading plan, and I'll give you an example for myself, I do have a way in which I trade. Okay, I do have a specific time in which I trade. I know some people on this call, you know, some are, I know like someone like Terry Ngurani, she's a mom, and I know that she trades in the night when she's, you know, the baby is asleep. So you find that, you know, new moms would probably want to trade at night and so on. I trade from the London session, during the London session, from 9 o'clock to maybe noon. Yeah. Some people trade the New York session, maybe because they work during the day. I have one of my team members, Tukuza, she trades at night when all of us are sleeping. Why? Because she works night shift. Now, once you know your pattern in terms of when you know that you're going to be trading, it's good to just actually just write it down and then begin to practice it over and over again. Now, when it comes to methodology, it's broken down here for you. Methodology covers trend, for example. When you go into the market, yeah, when you start trading, when you go into the market, what trend are you trading? I've come across traders who trade consolidation. I remember one of our, you know, one of the very, very good traders in the past, we used to call him Mr. GJ. He was very good with trading consolidation. And, you know, that's when the market is ranging. I personally dislike trading consolidation. I don't even know how to trade it really well. And I tend to get caught up in terrible pullbacks. So I never trade consolidation. So you have to decide, once you begin to understand this information, what trends are you going to be trading? Are you going to trade consolidation, reversals, breakouts, and so on? And then stick to that. Secondly, what instruments are you trading? There are some people who just trade currencies strictly. There are some even who say, I'm only going to trade Euro USD or GBP JPY. That's okay. You need to decide what instrument you're going to trade. Some of you know I love indices. So for me, I've been trading indices for a year consistently. Okay. There are some people like my friend Bernard Kiraide. Every time Bernard calls me, is to ask me about gold, for example. So if you know what it is, instrument you trade, you can literally just say, I'm going to trade gold, or I'm going to trade indices, or I'm going to trade Euro USD, and stick to it. Okay, that's part of you planning your methodology. Then of course the time frame. What time frame do you trade? And this is also part of planning your trades, right? Meaning that when you get into the market, like for example, myself, when I get into the market, the first thing I do is I look at the daily chart, okay? Why? Because I'm an intraday trader and I love to look at the longer time frames. Those are the time frames that actually make sense to me. If I go into a lower time frame, I'll look at the 30-minute chart, okay? That's when I'm trading intraday. For scalpers, they might decide they want to trade the smaller time frames, maybe 5 minutes, even 1 minute chart. So depending on what kind of a trader you are, you'll either be an intraday trader or a swing trader. So you need to know, okay? Then part of your methodology is also you determining your entry, okay? Your indicators, your stops, as in, and if you can write this down, right? And like literally write down this methodology. Like that's what basically I'm trying to encourage you guys to do after this call, especially for the new people who have not done this exercise. Go through this, just write it down so that it sticks with you, so that you know that this is my methodology. Now, the second thing, or the second structure, or what is it, component of your trading plan is going to have to do with your money management. Okay, now money management has to do with a couple of things. Risk of ruin, like what is the risk in the market, like for you, by the time you lose your money in the market, you know, what are the risks involved in trading? You need to understand that. Things like position sizing, I'm going to really focus on this at the end of this presentation, hopefully in the next 10 minutes, because I think it's very important and it's a crux of risk management. And then money management is your capital. How much capital are you using to trade? Yeah, for example. And then of course your loss, your profits, these are things that you need to know, like loss, how much are you willing to risk or lose? Profits, what are you willing to make consistently, or what are you looking to make consistently? And once, let's say for example, when the money management goes even beyond, let's say, just making money, it also goes towards planning your money. Okay, so when you make profits, what do you do? Do you withdraw the money, or do you keep it there compounding for a week or a month or 6 months. Yeah. So you have to have a plan prior to going into the market about what you're going to do every time you make money. I know some people in our team, they withdraw daily. Someone like Oscar, for those who have traded with Oscar, the gold master, you know, he trades every day, and every day he's withdrawing money from the market 2 or 3 times. So I find that a very good strategy, because at least you begin to taste your money and experience how it is to make money from the markets. Even if you're withdrawing 1,000 bob, it's your profits, guys. You're allowed to withdraw it. Okay. Some people decide they want to compound, especially, for example, the guys who are, you know, on the 52 weeks challenge. Yeah. And we'll talk about that later. We have said that, you know, we'll compound our small accounts for a period of time, and then we will withdraw. Now, once you withdraw, what do you do with your money? That's part of money management, by the way. Is that money you're withdrawing to pay a bill? Is it there to put into a home loan? Is it there for you to, you know, take your wife for dinner, or your hubby, you know, or go on holiday? Like, some of these things we don't think about at the very beginning. We tend to be very focused more on making money. And when the money comes, you find that you don't really know where it's going, because you just spend it. But if you're going to do this professionally, consider the fact that if you're working somewhere, you actually plan for your salary at the end of the month. So it's the same thing with your Forex income. Do you have a plan for it? So that's part of your money management. Then, of course, we always say, you know, like, when it comes to managing your money as well, you also learn to become a great loser. Okay. When I say a great loser, I mean, we need to, at the very beginning, learn how to take small losses quickly and consistently. Okay. And I know this is something that a lot of people struggle with. Like, you see, you have a loss in your account, you're in a drawdown, and instead of jumping out of the market with that small loss, you wait for it, you sit on it for, you know, hours on end, the whole day, sometimes 2 days. I mean, it happens to me all the time as well. So when I'm talking to you about this, I'm also talking to myself. You know, this is just a reminder that if you're not okay with losing money in the Forex industry, then you will always be losing money in the market. That's for real. So the best losers win. That's basically a principle in trading. The best losers win, meaning you take your quick losses, but then when you take your wins, they'll be big, right? Okay, so after that, another component of your trading plan will have to do with your mindset and psychology. This is something that you're going to have to consistently work on from the first day of trading. From your first day of getting into this industry and telling yourself, now I'm a Forex trader or I'm a student, you have to begin to work on your mindset and psychology. So one of the things that has helped me over the last couple of months is, for me, from day one, I started working on a trading journal. When I say a trading journal, it's just an exercise book, a diary, whatever. And I journal all my trades, okay? And I remember, I think Dorcas, I think last week mentioned, she also does the same thing. I could be wrong, maybe it was not her, maybe to somebody else. Literally, you just have a book. When you enter a trade, when I call out a trade idea and you decide to take it, you simply journal it. At the end, if you make profit, you write, I made profit, or these are the trades I took today. These are the losses I made. These are the gains. Every single day since I started trading, actually, let me correct that. Not since I started trading, but since May of last year, when I started my channel, for my Telegram channel, where I share trade alerts, because of accountability and because I needed to know, are my trade ideas really working? Are people actually making money from them? I had to begin to journal. Now, when I started doing that for other people, I mean, to monitor the trades, I also realized that it was beginning to increase my confidence as a trader. So when I see that I'm getting wins, I'm like, oh yeah, now I'm beginning to understand how to trade. You get excited and so on. So journaling is very good. It's part of helping you work on your mindset and your psychology, okay? And we know that, you know, your frame of mind determines how you trade. When you're journaling and all that, you know what your strengths and weaknesses are. You know what pairs you don't want to ever trade. You know, I mean, all these things. So you write down everything. Like, if at the end of this market day today, you can simply go to your journal and say, okay, fine, what happened today? what losses did I make? What did I make? What wins did I make? What did I learn? Okay, what and why did I make the losses? Like you can see and say, okay, maybe here I entered the trade late or I entered too early and so on and so forth. When you do this over a period of time, you then have a frame of reference. You can always go back and tell yourself with confidence that, yes, I'm a trader and my success rate is maybe 60%. That's how I was able to know over time that I was actually growing in my knowledge as a trader and I was becoming better and better. So it makes you fit healthy. It becomes a daily routine. It's just a record keeping strategy, okay? In terms of the writing down what you're doing. Then of course, you have to keep on building your mindset. What I found with new traders and even with older traders, we sometimes, get hit by the market. We lose confidence, and you guys know how it is when you lose confidence in the market. You trade poorly, and so on. So you always have to keep on beefing up your mental space. That means you need to read up on, things to do with mental strength in trading. There are books I recommend, like Trading in the Zone and so on and so forth by Mark Douglas. I'm sure some of you have already read that book. If you haven't, I always recommend it, like all the time. There's another book called Meditations for Emotional Management in Life by Marcus Aurelius. There's another book called Emotional Intelligence 2.0 by Gene Greaves and Travis Brad. So those are books I recommend. Read anything to do with your mind, especially as a trader. And the last one here is, the thing is, you may never control, the market and how it moves, okay? And this is what you need to take away from this section. But you can do that flawlessly by flawlessly executing the trading plan. So if you're executing your trading plan, okay, you don't have to focus on trying to control the market because you're in control of your plan. So whatever the market does is neither here nor there, you're still good to go, yeah? And I know that the hardest thing about trading, and this is from a very personal perspective, because for me, I have struggled with this topic for for very long, risk management and money management and, psychology and all that. But then for me, I realized that the hardest thing about the hardest thing about trading is when you trade alone, okay? And more so when you become your own risk officer, okay? Meaning that you're your own accountability partner. And that's why sometimes we encourage you, if you're new in trading, find an accountability partner, find an accountability team. Whoever introduced you to trading, please latch onto them. Don't let them go, bug them, keep on, just telling them how your day is going. Even when you're in here 1 month, 2 months, don't stop. 3 months, 6 months, don't stop talking to somebody about your trading. Because all through your career as a trader, there'll be highs and there'll be lows, okay? You will not always be making money. There are days you will just feel the market is just not with you and so on. So you need an accountability partner to keep you in check. And also when you make the mistakes, you need someone to report to, because guys, you cannot be your own risk officer, because you will never be able to criticize yourself positively. Most of the time when we criticize ourselves in terms of trading, we are so hard on ourselves. But sometimes you need another eye to come in and tell you, hey, this happened, so on. This is what could have been done better. And it's a much better frame to be. And that also helps you with your mindset. Then the next part of the structure of your typical plan is your tools. This is obvious. You need a good computer. Today I had really serious challenges with my laptop. In fact, I'm having challenges with my laptop in general. And sometimes it just decides it's just not waking up. So obviously I need to invest in another one. So you need to have a good computer, of course, power source. Sometimes I hear people, hey, power has disappeared. What's the alternative? Do you have a power bank in case you're in a trade? And if it's an emergency, sometimes you can call your broker and tell them to shut down the trade. These are things that you just need to know. It's common sense, but I'm just mentioning them because it's important. So like I said, for me, my daily game plan is very simple. I wake up by 9 a.m. I'm at my desk. I'm doing my pre-market routine, which is my analysis. I'm listening to loud music in the background because it puts me in a very good space for trading. And I found that when I don't have my music, I don't trade as well. So yeah. Then of course I look at the fundamentals. This is something you can adopt into your routine. So I look at the fundamentals, meaning that I'm looking at different news websites that basically tell me, okay, what happened the previous night? Did Donald Trump say something? Some of the websites are like Daily FX, fxstreet.com. So again, if you're new and you don't do this yet, please develop this routine. Develop a routine. It doesn't have to be what I do, but it has to be something that you can be doing all the time. Then of course you identify the session. So for me, you guys know I trade and I love to trade the London session, and I'm more specific on trading 3 times a week. Especially as an intraday trader, I don't feel like if I'm doing intraday, I have to trade every single day. Sometimes if you're scalping, yes, you may want to trade every day, but if you're an intraday trader and you're holding on for like 50 pips to 100 pips on a trade, you can actually just trade one session 3 times a week. Then of course, I put myself in the right psychology. I do my morning meditations. That's part of my routine on my game plan. And then of course, I also create a conducive environment, because if you're stressed out, you cannot trade. In fact, if you're stressed out, just never trade, never go into the market, because you just will not, you will not do well. Then of course, there's the pre-session outlook, which is, the way I'm analyzing the market. So from 9 to 10, I'm on my laptop analyzing the market. You guys know that I share trade ideas with people locally and internationally on the Vibrata platform. Okay, so I have to like spend some time, a bit more time than I would on my own, to just make sure that I'm looking at the right entries, so that by 10 o'clock, when I'm sharing trade ideas, I'm good to go. I'm not late. Sometimes I do delay because it takes some time to actually identify good entries in the market and so on. And sometimes maybe I'm just not in that space. Sometimes you just have a good day, and other days not so good. But my point is, have a game plan, have something you do routinely every single day. That's basically it. And I like to tell people that, you're not a creature of your circumstances, you're a creator of your life. And that's what trading is about. That's what this planning your trade is all about. Because if you don't have a plan, then you're a creature of circumstances. If Donald Trump decides to say something, you just have no clue what to do, and you're panicking rather than making the decision to get out, because your trading plan says, if the stop loss moves, if my loss goes beyond 3%, I'm out of the trade. So that's what your trading plan is there for. So before I wrap up, there's one bit that I want to now emphasize on, which I think is part of risk management. It's a big deal, but I just want to kind of give an idea of what it is, kind of break it down for you guys. So this is the topic of position sizing. Okay, so what is position sizing? As you can see here, it says position sizing is the part of your trading system, because what we've talked about is you developing your trading plan or your trading system. So it's a part of your trading system that tells you how many contracts to buy or sell in a trade. This is basically telling you what to do, okay, or what size, as the name suggests, position. What position should you take in the market in terms of the size of the trade? That's just layman terms of it, yeah? So position sizing will help you determine the following. It will help you determine how many contracts to go long or short for a particular trade. When we talk about contracts, guys, this is just trading language. Don't take it too, it may sound a bit intimidating. Just know that what we are saying is, you just need to know how many trades you need to you go long or short, things, how many, what amount of money basically you're going to be taking on a buy or a sell for any particular trade, or taking up, yeah. Then risk per trade, number 2 is your risk per trade and overall risk to your portfolio, obviously. And then your number 3 is your expected returns to your portfolio. So I'm just going to break it down for you guys. So what are the steps? Okay, so these are the steps. Number 1, you need to check your net liquidation. Again, this is just terminology to mean your capital. So let's say, for example, you have a capital of $100. That is your net liquidation. That is the amount of money that you're going to begin trading with. So that's the first thing you need to do. Figure out today, based on yesterday, if I made a profit or a loss, what is my capital? And then secondly, determine your risk per trade. Okay, so your risk per trade, how do you do that? Risk per trade. Now your risk is the maximum loss per trade. Okay, so this is the maximum amount of money you're willing to lose per trade. That's what we mean by your risk per trade. Okay, this is very, very important. We've touched on it earlier. We've touched on it on different sessions. I type about it on my channel, but I want to emphasize it over and over again, especially if you're a new trader. The thing about myself and some of us who started a year ago is we didn't have these conversations in the beginning. Okay, when we started trading, we were just interested in making money. That was it. We didn't know anything about stop loss. We didn't know anything. It was just like, you see blue, you get out. You see blue, you get out, you know. And that really, really lengthened our learning journey, okay? And some of us took forever to learn, okay? And I say this vis-a-vis some of the students I see coming on board right now, and how much more disciplined those new students are compared to us. For example, for me, I keep on saying, and I'm not proud of it, it's just something I say because it's the reality. When I started, the number of accounts that I blew were very many, okay? At least more than 5, 6, 7 accounts. Now, I don't want you guys to go through the same thing. And the reason why I went through that experience, which was horrible, okay? For like 3 or 4 or 6 months, I was unable to withdraw money from my trading account because I was consistently blowing my accounts. And the reason being, I never had the initial conversation about risk management and things like what I'm talking about, determining the maximum loss you need to take per trade. And also things about mindset and all the things I've just talked about. Now, the second thing is part of determining your risk per trade. This is the maximum you can lose if your stop loss is hit, okay? Which means that you have to use stop loss, okay? Then this is the loss. This loss should never be more than 1 to 3% of your capital, okay? Some people say 1 to 2%. I know for a fact, this, I don't even need to come and check your accounts, but I know many people on this call do not follow this rule, okay, of 1 to 3% capital, okay? We know these things, but we don't really implement them. And I just want to tell you guys, for us to move from one level of trading to another, we have to get to a point where we begin to follow the rules. Yeah, so my suggestion is going to be this. And because I know we are human, okay? I am human, you're human. I've done the same things you've done. You guys will do the same things I did when I got started. Even if I tell you not to, you shall. You shall over leverage. You will not use stop loss. You will not know when to get out of the trade, and so on and so forth. So what I suggest is what I recently just decided that I was going to also do for myself is have more than one trading account, okay? So what that means is that one trading account is for money that you can afford to lose, okay? Another trading account is for money that you cannot afford to lose. Generally in life, you cannot afford to lose money. But hey, we are human and we know, okay, that sometimes we will see a good opportunity in the market and we will want to take a big position on that trade, okay? And this is especially, again, for new traders who have not yet developed the discipline. Some of you older traders are probably more disciplined. I can give an example of Jeremiah Kendago. I've watched him as a trader. This guy will take trades, and when he gets to his 3% profit in a day, he's out of the market. I know there are people here who can't relate with that. Them, they just want to see money in their account growing and growing and growing. So to curb that early, especially again for the new people, please have more than one trading account. So maybe minimum 2 accounts, okay? So one can even have $100. Both of them can even have $100, okay? Because we also don't want to stretch people who have really gone out of their way to fund their accounts. You can have 2 accounts. One account, stick to the rules, okay? Use stop loss, okay? And I'll share other rules after this shortly. Risk only 1 to 3% of your capital, okay? And in the beginning, with that strict account, try and only risk 1% until the day you're confident, okay? There's no hurry. Then you can have your other account, which you do what you want to do, okay? And even that other account, I can suggest that's the account that now you decide to, you know, like on the 52 weeks challenge, yeah, and I'll talk about that again, like I mentioned. It has a more aggressive trading plan. So you can literally probably do what you need to do with the other account, but at least have one account with this strict plan, because there's something about the strict plan that will really transform your trading as a trader. That said, so when we are determining your position size per trade, because this is what is called position sizing. So this is just a practical example, okay? And I hope I tried to make it as simple as possible. I hope this diagram is not complicated. I hope you guys can see my screen. Can you guys see the equation? Can you guys see the equation? Someone let me know. Can you see the equation fully?
Yes, we can see.
Okay,
yes, we can.
perfect. Okay. So this is how you determine your position size per trade, because sometimes people are wondering, what is position size per trade? So let's assume, for example, that you have an account of $10,000. Okay, this is your initial capital. And now this capital can be any amount. It can be $100, it can be $1,000. For the purpose of this example, just for you to understand and for mathematics, this is how it works. So to calculate your position size per trade, your position size per trade, okay, because this is part of money management and risk management. Now, what you're trying to do is to calculate the number of lots, okay, that you're trading, okay. Now, the equation is net liquidation, which is your capital or your equity, okay. Equity capital is usually the same thing. But obviously when you're trading, you see the difference. Balance equity is what you actually have to trade. So that's your capital. So the net liquidation, which is $10,000, times your percentage risk per trade. So let's say you put it at 1% because you're being conservative. You can change this figure and put it at 3%, okay, or 2%. Divided by your stop loss distance. Now this is just basically the distance from the entry price to your stop loss, okay? So let's say we use 30 pips, and I'll show you exactly how you'll be able to calculate your stop loss. So stop loss is 30 pips, right? Times the value per pip. Now I'll use Euro USD because Euro USD, the standard value of a Euro USD is $10 per pip for a standard lot, okay? So usually it's a round figure. There are other pairs that have, 8 point something per pip, and you can use a certain tool to calculate that. Now, when you do this calculation, so 10,000 times 1% divided by stop loss 30 times the $10, yeah, you'll get 0.5 contracts. What this means, guys, or 0.5 lots. What this means is your position size per trade should be 0.5 lot maximum for a $10,000 account, risking 1%. I hope that makes sense. Now, so 0.5 contracts, if you understand, one lot size is usually 100,000 units. So 0.5 will be worth Euro 50,000. So basically you're purchasing, because here, let's say, for example, if you're purchasing euro against the dollar, you're buying 50,000 units of the euro against the dollar. That's basically what this is about. Now, depending on the leverage your broker has given you, this can end up being much more, okay? Because maybe you've been given leverage of 100 or leverage of 400. I hope you understand what leverage is, guys, but this is in the basics of the academy, so I won't go into that. So I hope this is clear. Yeah, this is important so that you know how much to risk per trade. So if you had an account of $1,000, can anyone tell me what the number of lots at 1% should be using 30 pips with this value of $10 per pip for Euro USD? Anybody can do some quick math? I wish I had a whiteboard, but I do not. So let's say, okay, maybe I can, how do people use this tool? So let's say I have $1,000. Sorry about that, clearly. So let's say I have $1,000, so 1 and then 1,000. I'm trying to draw this as well as I can. So times 1%, okay, divided by, yeah, 30, because my pip is 30 pips. We usually recommend 30 pips, but you can do anything. You can do 8 pips, 20 pips, you can calculate that, times the value per pip. So Euro USD, the value per pip for a standard lot is 10. Sorry, the value per pip for $1,000 would be 0.1 if you use 1%, right? So 0.1. How do I get back the pen? Okay, guys, what is the answer to the question in the meantime? Or are we together? Have I lost somebody? Have I lost you guys? Hello, hello. Anybody out there? This is a question to all of you based on what I've just talked about with the position size per trade. What would it be if you have an account of $1,000? What would the calculation, the number of lots be? You're just trying to get the number of lots you need to trade or you can trade with $1,000. That's basically what I'm asking. Okay, should I pick somebody to answer this question? Oh. Who can I pick? Dorcas. Hi, Dorcas.
Hey, Lilo, I'm still doing the math. I had to put my calculator.
Okay. Okay, as you're doing the math, anyone else who has gotten it? Guys, it's not complicated. It's just 1,000 times 1% divided by stop loss times the value per pip.
$3.3.
3.3.
Yep.
How did you get 3.3?
I was thinking 1,000 times 1%, that would be 10 divided by 30 times 0.1, that would be 3. So 10 divided by 3, I think that would be 3.3.
10 divided by 3. Why 3? Okay, if you're risking 1% on 1,000, how much are you risking?
$10.
$10, right? So, okay. So basically what I want you guys to understand, first of all, is that, yeah. Now, if we do this math again, because I don't think, let me, that's not the answer I got when I did it. Let me just see, 1,000. Unless I've done the calculation wrong, the equation. It's 0.03.
0.03.
That's what I
Thank
got
you.
too.
Or yeah, so that's the number of lots you need to trade. Maximum at 1%. Are we together with everyone? Has everyone gotten that? Guys, I'm waiting for your yes, no's, maybes. Yes, no, maybe.
Yes.
I don't mind. Okay, so I'm hoping we are all on the same page. And don't worry, you can always this is recorded, so you can go through this again. Yeah, so don't stress on this right now. But I just want you guys to know that when you're planning your trades, this is what you must do. Okay, so the steps are very simple, and we'll go through this again. Check your capital, know what is in your account at that particular time. Okay, determine your risk per trade, meaning that you say you're willing to risk maybe 3% of your capital or 2% or whatever. Yeah, which basically means, guys, if you're risking 3% of a $10,000 account, it means you're willing to lose $300. If you're risking 3% of a $100 account, you're willing to lose $3. That's basically it. Yeah. Then determine your stop loss, meaning the stop loss distance. Okay, and there are various ways in which you can determine the stop loss distance. You can use the candlesticks. Okay, you can use it's called what? You can use the position size calculator, which I'll share just now. Yeah, basically you can use the position size tool as well. And then number 4, calculate the number of lots traded. So you need to know the number of lots you're trading. Don't just enter into a trade like that. Don't just say, I'm going to do 1%. You need to understand what does that mean, because once you realize that you're trading one lot, then what you'll end up doing is taking multiple trades that add up to one lot, as opposed to entering 1 or 2 trades of one lot, or entering 1 trade of one lot. You'll be able to now say, I can take 3 or 4 trades that max out to one lot, and I'll still be risking 1%. And the thing is here, if you do this, your stop loss will never change. Okay, it should always remain the same. Okay, so even if you reduce or increase your risk, even if you increase or reduce your stop loss, your risk must never change. Okay, it must always remain 1 to 3%. So even if I've seen Cliff asked a question here, what if I see what did you say? You asked a question, Cliff. I saw it earlier. Are you allowed to push the SL a bit higher if you see the market might switch movement? By the way, you're allowed. But the question is why? Would you want to increase your risk or your position? You understand? Why not just take the smaller loss and recover in a new trade? The danger of moving your stop loss is you get into the habit of moving your stop loss. And then the day the market gets you, it gets you. So I'm trying to force us to start using stop loss, okay? Or at least having a risk plan. And that's why I said have 2 accounts. Have one account that you're just sticking to the rules, and then have this other account. And let me tell you guys, I know it's not easy. I know it's difficult. I struggle with it as well, okay? And that's why I'm trying to compromise and say, have a separate account to do your madogodanios. You know, you're just no plan, nothing. And then have this one account that you're sticking to the rule. Let me tell you something, you'll see the difference. Yes, your trades will hit stop loss, okay? But if you're losing $3 3 times or 4 times, and you're making, let's say $20 in one trade, because your risk to reward was good, and this time this trade went the right way, then you're still making money. And that's what I want you guys, especially you new guys. The older people, we are very difficult right now. Changing our ways is near impossible. And that's why we bribe ourselves with you know, this other second account. So Sharon Karua said 3.3. Oh no, that was okay. That was Yeah, very true. The habit of changing a stop loss is addictive. Yes, it's very addictive. Now, so this, just have this plan. Even if you don't do anything with it, just have it. Write it down. Put it somewhere on your board. One day, please try and use these steps. They are very simple. There are 4 of them. Check your capital. Determine your risk per trade. Okay, your percentage risk that you want to lose. Determine your position size per trade. Okay, and then keep calculating. Just know your calculations, basically. That's what we are saying, okay? Now, for reference, we have 2 tools that you need to become familiar with to help you stick to this strict trading risk management, okay? And those 2 sites are myfxbook.com, which has a position size calculator, and FXTM profit calculator. Now, I'll open those sites shortly, but I just want to wrap up with this slide that gives you now the summary, and you can take a photo of this, okay? It gives you a summary of the rules for risk management, okay? These are the rules. Always risk a fixed percentage of your capital. Do not change your risk percentage. If you've said it's 1%, it's 1%. If it's 3%, it's 3%. Don't go beyond 3%. And that answers your question again, Cliff. Do not move your stop loss, because then you're going out of this rule. The minute you move your stop loss, just know that rule number 1 has not been kept to, and now you're trading riskily, okay? Then at 1% risk, think about it. If you have 4 losses, you're only in a 4% drawdown. At 3% risk, if you have 4 losses, your drawdown is 12%. At 10% risk, if you have 4 losses, what is your drawdown? You understand? So it's up to you to decide, do you want your drawdown to be 4%? Yeah, with 4 trades, 4 losing trades, or do you want it to be more? That's number 1. Number 2, always use a stop loss order. Always use a stop loss order. Again, this is for your strict trading account. Or this allows us to predetermine the amount of loss in a losing trade. This is like trading binary, only you're trading Forex. Okay, guys? So when I say binary, if you guys have been in Kendago's class and he explains to you the way binary is, binary, before you go into the market, you already know how much you're going to lose, and you can't change that amount. If the trade goes the wrong way, you lose that amount. So you kind of go with a good mindset, because you're already ready to lose. The unfortunate thing with Forex is that it gives us the power to determine our losses, which is also not good, in the sense that you can manipulate stop loss within a trade and end up just, not keeping to a plan. Number 3, always use a take profit order. There are people who tell me, or they send me screenshots and they're like, what is happening to my account? And when I look at their parameters, they did not have a take profit, okay? Or they calculated their take profit the wrong way. So if you've been in a beginner's class, you definitely know how to, by now, to calculate pips and all that. If not, just do your revision and make sure that by the next time you're getting into a trade, you know how to calculate take profit for all currencies, whether you're trading metals, indices, oil, and so on. Then of course, take profit allows you to predetermine your profit in a winning trade. You know in advance that if I enter here and put my stop loss here, this is how much I am making, okay? Then number 4, always ensure your risk return ratio is 1:1.5, okay? Meaning that for every $1 that you're risking, you're gaining 1.5. That is your target, okay? I hope that is making sense. So don't do 2-1, whereby now your stop loss is behind there, 2, and then you're trying to gain 1. That is poor risk management. Okay, and then so this also gives you another thing, when you do 1:1.5, ensure that when you do your analysis at the end of it all, you're targeting a win rate of a percentage of 60, meaning that at a minimum, you want to be winning 60%. So if you're not winning 60% of the time, I can assure you there's something wrong with your risk management if I'm to investigate your accounts thoroughly. Secondly, probably you still need more time in the academy and more time on demo, okay? And your trading journal will be able to reveal, like, did you come out of the trade prematurely, and so on and so forth. And that's why the trading journal is also part of the trading plan, okay? So that's basically it. So I don't know if anyone has questions. It's already 4 minutes to 9 o'clock and I need to wrap up. But what I want to do is to open the position size calculator, which is the last thing, to just show you how to calculate your position size. So let's see. Anyone with a question in the meantime, feel free to ask. So when you go to, this is, how come I can't see my screen? Okay, so I'm going to my FX book. Instead of calculating it manually, the manual bit is just to help you understand. It's important to understand why we do what we do. But now an easier way is to go to my FX book and then you simply look for the position size calculator. Okay, so once you're on this tool, guys, and this is the last thing we'll talk about before I take questions. So remember your capital, okay, which is your account size, which is your net liquidation. Okay, that's the vocabulary we are using. So your net liquidation or your account size is, let's say, $100, or let's start with $1,000, for example, because some of you do open accounts with $1,000. Now, your risk ratio, we have been told as a rule, don't risk more than 1 to 3% of your account. This is for your strict trading account. So let's say we risk let's say even we risk 3%, okay? Your stop loss will be 30 pips, because that's your risk. Yeah, your contract size is standard. We are trading Euro USD. If we are to calculate, this is what happens, okay? So risking 3% on $1,000, okay, your lot size will be 0.1 and your target profit will be $30, okay? So one thing that should never change when you're determining what lot to use per trade is your risk. Remember, 1 to 3% per trade. So your entire capital should never be risked more than 3%. This should never change, therefore. Account size can change, stop loss can change, but your risk can never change. So if your stop loss changes, let's say, Cliff, you want to put 100 pips stop loss, then your lot size will reduce, but your risk will remain. And the money you're targeting will still be $30. Does that make sense? Yeah. So if you're trading something and you're feeling, okay, let me push my whatever, you can't push when you're in the trade. You can't move your target when you're already live in the trade. Plan it before. If you're looking at a trade and you're unsure about how it's going to go, and you feel like maybe this thing might pull back 100 pips, then plan for it in advance. The problem is we plan later. Okay. So let's say we put 30 pips, no, that we've already done 30. Let's say we put 20 pips, because you can. There are some trades you can enter with 20 pips stop loss. You can then use 0.15 as your lot size. Your amount of money will still remain $30. So are you guys getting the drift? Yeah, if I put 50 pips, okay, and I calculate on Euro USD, my lot size to use is 0.06. So what is always changing is your lot and your stop loss, and maybe even your amount. So let's say your amount here goes to, let's say, 500. 3% still, right? So at 500, the money you're expecting at 50 pips stop loss is $15, and the lot you'll be using is 0.03. So I don't know if you guys are seeing, when you already know what your expected return is prior to going into the market, doesn't it make it easier for you to trade, or more confident or comfortable that you know that I'm willing to lose? If I lose $15, it's all right. So if you're at if you're at $100, guess what happens? Your money is $3, that's your profit. Yeah, and your lot is 0.06. Of course, this is now too low. This is a micro lot. Some brokers don't offer this kind of lot size, so you'll probably just trade 0.01. Yeah, and so on and so forth. If you reduce your risk to 2%, I think for you it will be the same. But if you do 30 pips here, it will be the same. So $100 is very limiting still, okay? So you'll really be limited to your 0.01 lot size for a while until you compound your account. Every time your balance grows, so let's say from 100 it grows to 200 or 250, yeah? Then you see your lot size increases and your potential profit also increases. So this tool is very, very powerful. There's another tool that I like, the profit calculator, FTMO's profit calculator. Is it FTMO? What is it? FXMO, FX. Profit, I think FXCM. Profit calculator, Forex, let's see. FXTM, yes. So they have a profit calculator here, okay? Now, this helps you to calculate your profit in advance as well, based on the currency you're trading. Why, guys? Because all these currencies will give you a different dollar amount per pip at the end of the day, okay? Because they're all valued differently. So Euro USD is usually a standard $10 per pip for one standard lot size, and others are less. So let's say, for example, you enter Euro USD, you're buying, this is the entry price, this is the exit price of 10 pips, right? Open price, close price. You're trading one standard lot, yeah? And the deposit currency is USD. So if you're trading one standard lot, this is what you should earn at the end of the day, trading one lot. If you're trading 0.5, you earn 50. This is kind of straightforward, but let's say, what if you're trading another currency like AUD CAD? Do you see the amount changes? From $50, you're going to earn $36 for the same lot size. So this will give you a target. Now you can say, if I'm going to trade AUD CAD, what would I rather trade, AUD CAD or Euro USD? Or if I love the AUD pairs, how many trades do I need to take of 0.5, for example, to make $100? Not 2 trades, 3 trades. If you're doing Euro USD, you just need 2 trades. Does that make sense? So these tools are there to give you a possibility to plan your trades in advance. Guys, you can plan them to the T. Usually one of my mentors, he usually says, he's an intraday trader, so he takes maximum 3 trades in a day. For intraday traders, that's realistic. 3 trades in a day. So if you're taking 3 trades in a day and you're targeting a certain amount of money, you can use this calculator to help you calculate the trades to take or something like that. I hope that is making some sense. So guys, that is the end of this training for today. I hope it's been of value. Is it possible to export trading history from MT4? Yes, it is. It is. There's an export button on your MT4. You can do it on your laptop. You can do it on your laptop, your MT4 on your laptop. You can export into Excel directly. Can trade 0.33 lot size to lose a maximum? Oh, I think Jeremiah, you made a comment. Do you want to just emphasize so that? Or can trade a 0.33 lot size to lose a maximum of $100? Yes. Yeah, you're correct. You're right. Lilo, when you call, okay, one thing to go. One more thing that I need to mention, my trading alerts. This I think is very important. Very, 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 very important. And this morning I wrote basically idea of how you're able to take my trades. Oops, it's 9 o'clock, so the other call has started. My bad. Eating into someone else's time. But guys, yeah, so how do you take my trade ideas? I usually, if you guys have noticed, I usually just give a whole range of trade ideas, okay? And I do that so that if somebody comes late, they can find, you know, at least 1 or 2 trades, and so on and so forth. And then there's some trades that some people will not take, like some people don't trade indices, some people don't trade metals, they just stick to currency. So just to give people variety, and also based on what I see on that day. So what I've done as a rule is I try to share about 8 to 10 trades a day. Sometimes I'll do more, but 8 to 10 is the standard. What I am going to suggest you do, if you're new and you've not traded with me for like 2 months, please stick to scalping. Take your 10 pips and get out of the market. Don't try to do more, just take your 10 pips and get out of the market. Because guys, my trade ideas are also based on intraday targets. So sometimes you'll see that I personally, I am still in a trade when some of you are already out of the trade. And I'm still holding a trade 2 days later when some of you already got out of the trade within the first hour or so. So there's a reason, okay? But if you're new with me and you haven't taken my trades and you haven't experienced how it is trading with me, trade on demo. Trade on demo until you feel confident that the trades I'm giving out are good. Don't enter and then start asking, oh my God, stop loss, I don't know what, all those things. Just don't do that. The market isn't going anywhere. You'll always have the market to trade and catch up. Secondly, if you're going to take my intraday trades and you want to hold them, statistically, majority of my trades, let's say 80-90% of my trades close within between 24 hours to 3 days to 72 hours. Most of the time. So if I call a trade out on Tuesday, it should be closed out by Thursday, Friday. Okay? Usually. I rarely do I see, usually I'm like, okay, it actually came back. At least you'll make your 20 pips, 30 pips, 50 pips. So if you're going to go the long route, don't confuse it with scalping and then start saying, oh my God, this trade has gone the other way. Choose what you want to do. If you're new, if you don't like intraday, scalp. Stick to scalping, okay? And wait for the scalp 10 pips to come in and get out. Sometimes the trade will go the other way, okay? If it does, you should have your own personal exit strategy, meaning that what I've just talked about. When are you willing to get out of the trade? At what point do you tell yourself, now I have to get out? Is it when my account has gone down by 1%? Is it by 2%? Is it by 10%? Is it by 100%? You understand? So I need to emphasize this because there are people who make money with my trades and there are people who lose money with the same trades. So sometimes I'm like, okay, I don't understand. But then I'm beginning to understand because I realize people are scalping, but they also want to intraday. They also want to hold the trade and they were not ready to hold. For me, I'm ready. My trade can go and I'll be like, okay, let me just chill for this trade because I know it's coming back because it always comes back. Yeah. So I hope and then take 1 to 2 trades at a time. Don't jump into everything. Just because I've given 8 trades, do not enter all 8 trades because imagine if you're trading $100 and you're supposed to risk 1 to 3%, the minute you go beyond 3%, you take a 4th trade of 0.01, you're over and above the rules. So if you have your 3 trades, stick to that. Wait for them to close. If you need to close one to get into another one, fine, wait. Guys, again, the market isn't going anywhere, okay? But that's for the strict trading again. Then there's the relaxed one. You can do whatever it is you want to that account. So that is it. I last got news updates about trading for my broker on 22nd July. I don't understand that question. When I call 3 trades at a go, how do I know the one to take? Do I go to the charts to check how they're behaving or how do I go about it? Usually, if I tell you buy now, buy now. I've already done the analysis for you. Feel free to confirm, but don't blame me if you enter late while you're still confirming. That's it. Unfortunately, that's how it has to work, because then I wouldn't know how to advise you to go and check, because you can end up entering late and then I don't know. So I hope I answered that question, Faith. I do my best to try my best to analyze the right way. Sometimes, yes, I get it wrong, but that's the market. It will happen to you as well on your own. Then Kamukama, at least, okay, which sites can visit daily to get timely news? So for daily news, forexfactory.com, that's a must. It aggregates the news of the day, medium to low impact to high impact, forexfactory.com. We also have dailyfx.com. We also have fxstreet.com. We also have, what is this other one? There's another one, but there are quite a number. Your broker will also sometimes send you news, okay? Updates, what's going to happen in the market according to what they've seen, and so on. But those three are the ones I focus on. There's another site I need to also talk about, not a site, it's called Sentiment. So I do fundamental analysis, but I also look at the sentiment. Sentiment is basically what is actually happening. You know, guys, like what is actually happening, not what you feel like is going to happen. Because fundamentals is more like, okay, news has come out. What can we interpret to this news? We think that the price will go up or it will go down. But sentiment is actually what people are, how people's behavior in the market. So I'll give you an example here. If we look at AUD/JPY, and this is what I'll wrap up with this evening. This is a chart that shows client sentiment, meaning you and I. Oh yes, Uncle Migwi says there's Bloomberg. Yes, there's CNBC. Yes, thank you for that, Uncle Migwi, for the reminder. So this is key. Let me give you an example. And this has to do with how the banks trade. Jeremiah is here and he can tell you the way the bankers trade and the way we trade as retail spot traders is very different. So you need to also begin to understand that the banks can see you. They can see your positions. They don't know you personally, okay, that you're holding that position, but they can see all the retail traders. So let's say, for example, if all of us are net long, we are all buying, the banks can see and try and say, okay, maybe we can make money from this. Why don't we push the price down? Because most of these people are buying. So let's sell, drive the price down so that we wipe out the buyers, okay? And then when the buyers decide to change their mind that now the market has changed, they start selling. But guess what? The bankers start going up again. Now, the purpose of this client sentiment is to avoid, because you can never avoid 100%, but sometimes doing what the majority of traders do. Okay, so typical example. This is today, AUD/JPY client positioning. So you can see that a lot of the traders at some point, let's see from here in the beginning, these are the traders, okay? Traders were buying, okay? They were buying AUD/JPY. At some point here, you know, that's how the price was on the chart. You can see it on the chart, yeah? And then at some point they started selling, okay? Most of them were selling, then it went up. So this kind of gives you an idea. But something interesting is when we see here, when price was going up, what was happening? It was going down. So buyers or whoever, people were selling rather, but the price was going up. And I'm hoping this can make sense. And you can see the pattern here. Then the sellers decided, oh, let us buy. They started buying. Guess what happened? Price went down. Okay, so this is what is actually happening in the market. This is the client sentiment. So it gives you an idea that, you know what, sometimes instead of doing what everyone is doing, why don't you do the opposite? And you can see here, as price started going up again, sellers continued selling because they had been seeing it going up and they decided, I mean, you understand the thing. So it avoids you getting caught out. So this is also, you need to know how many clients are buying and how many are selling. It's not set in stone, okay? but it gives you a rough idea of why sometimes, I'm sure you've asked yourself this question, how is it price was going up and then the price was being pushed up, then all of a sudden all the buyers came in, right, continuing to push the price up because everyone is now thinking the price is going up, then all of a sudden it just goes down and you ask yourself how, but all my technicals were aligned. Okay, it's because the bankers came in and they do it. It may not be the best thing, okay, and sometimes they even get fined for trading against the spot traders, but it happens. I mean, for those who have done their research on the USD, was it the USD CHF crash or the Euro CHF, the Swiss crash of 2008, I think. And maybe, I don't know if it's Euro, it's Swiss. And honestly, this is the last thing I'm talking about, and then we are done. Is it Euro CHF or it was? USD CHF, let's see. The dollar against the Swiss. Trying to see if it's the one. Yes. So this is the last thing I'm gonna do before we wrap up. I think it's here. Let me even just clear this chart. I don't have to have these drawings here. So do you guys see this? This was in 2015, 13th January 2015. Okay. Let me. Wait, sorry. Where has it gone to now? Yeah, here. How many pips is this? This is about 20,000 pips. When in one day, the Swiss currency dropped 20,000 pips. Is it 20? Yeah, 10,000 pips. Yeah. Is it 1,000? No, this is not it. I'm trying to look for this one particular one. But there's one currency that was being traded against the Swiss. I think it's USD, or there's a Swiss pair. And it dropped 20,000 pips in one day. Yeah. And the reason being, the European bank had said that the euro, actually, yes, the Euro CHF, that's what I'm looking for. Yes, this is what happened. Yeah. So you can see for the longest time, the euro had been trading at a certain level, okay, at this zone for the longest time, since I think 2 or 3 years earlier. And then the bank had put, and banks do this, they had said that the euro will never go beyond, I think, what's the price here, 1.2, yeah. They said it, they just put a marker here, and they said that the price will never go beyond this point. So it was always playing here, just to protect the currency. But then certain banks, and these are the big banks, I'm not talking about the local banks necessarily, I'm talking about the Deutsche banks and all that, those big heavyweights, there are about 4 or 5 of them in the world, which are the main players. There are people, they saw a lot of people here and they were like, you know what, they kind of convinced the Swiss bank, central bank, to lower the price or drop it below 1.2. They came together and did their thing. And what were people doing at this level? They kept on predicting that it was going to keep on buying, because for the longest time, the euro price had never gone beyond 1.2. And then one day, because the banks can see where all of you are, they just short the market. And in one day, this thing tanked by 22,381 pips. And if you do your research and check the history, a lot of businesses went out of business. A lot of brokers went out of broking business. I have a friend of mine, he trades futures now. And he was telling me this story even way before when I was not even in Forex, of how he used to be a Forex trader and he was trading with one of these brokers. And this happened and he went into over $200,000 in debt. And it took him about 6 years to recover because of this. And what happens here is your account even goes into negative, whereby now your stop loss, you could even have a stop loss, but it happens so fast that the stop losses are not triggered and it just keeps on going. So the point of this conversation is that these things happen in the market, okay? But if you're looking at everything, you'll have an idea of how to trade. If you're not just focusing on technicals, or you're not just focusing on fundamentals, but you're also looking at sentiments and you're just putting it all together, you'll be able to see things that maybe other traders may not be able to see. So that brings me to the end of my training. I have totally gone beyond by 20 minutes. I apologize for those who may have been in a hurry, but I hope it has been value for your time. I would recommend having 2 accounts with 2 different brokers. Yes, you can even have 2 accounts with the same broker. I have 3 accounts with 1 broker, but I have 4 or 5 other brokers and accounts that I have with other brokers. So yes, have different brokers, because then you get to also see which brokers are actually better than the others and whatnot. You know, it's good to test different brokers. So I mean, from Scope, EGM, Primus, Pepperstone, IC Markets, I mean, there are many brokers. So any questions, guys? Are we good? So that's my advanced training on risk management. I don't know if anybody has a question. Anybody with a question? No question.
Yes, there's a question there. How do I know how much leverage the broker extends to me?
When you get started with your broker account, you usually chose a leverage. So I don't know what leverage you chose, but either you must have chosen it. Like 1:100, 1:400, 500. If you look at your account, it should be able to tell you. If not, just ask your broker, they'll be able to tell you. Most professional traders will recommend nothing less than 100 in terms of leverage. But obviously, as retail traders with small accounts, sometimes we push it with big leverage, just to give more room to our accounts.
Okay, thank you.
Welcome. Thank you, guys. So there be no other question. I thank you, Asanteni. You're welcome. You're welcome. You're welcome. And yes, I hope this was of value. We'll see you again next week. Please feel free to send in your suggestions in terms of what you would like me to to teach on. What I like to do is, rather than keep on repeating the same thing every week, I try and look at things that maybe are not very heavily covered in the academy, in terms of things that you not necessarily find in the academy. So things that you need to know but may not necessarily be there. For example, the last example I gave you of Euro CHF. So if you have anything specific you need me to teach on, drop me a line, let me know. Okay, so once again, Asanteni, and have a lovely evening.